In this video, we will talk about risk-reward ratios and their significance. So make sure to watch the full video. In the intricate world of financial markets, where uncertainty reigns and decisions are made in the blink of an eye, risk-reward ratios emerge as a crucial metric in a trader's toolkit. This in-depth exploration delves into the multifaceted significance of risk-reward ratios, unraveling the complexities that underlie their importance in strategic decision-making. Beyond a mere numerical ratio, understanding the nuanced role of risk-reward ratios is essential for traders seeking to navigate the volatile landscape of investment with prudence and precision. Section 1. Deciphering risk-reward ratios. Defining risk-reward ratios. At its core, a risk-reward ratio is a quantitative assessment that gauges the potential loss versus potential gain in a trade. Expressed as a ratio, it articulates the relationship between the amount of risk taken on a trade and the anticipated reward. The mathematics behind the ratio. Understanding the mathematical calculation of risk-reward ratios is fundamental. A clear grasp of how to determine potential profit and potential loss, and subsequently expressing this relationship as a ratio, lays the foundation for strategic decision-making. Section 2. The strategic role of risk-reward ratios. Balancing risk and reward. One of the primary roles of risk-reward ratios is to strike a delicate balance between the potential for profit and the exposure to potential losses. Achieving equilibrium is critical for maintaining a positive expectancy over the long term. Aligning with trading strategies. Different trading strategies may call for different risk-reward ratios. Scalpers, for instance, might seek a high frequency of small wins with a tight risk-reward ratio, while swing traders may opt for a more conservative approach with a lower frequency of trades and a more favorable risk-reward ratio. Section 3. The psychology of risk-reward ratios. Managing emotional responses. The significance of risk-reward ratios extends beyond the numerical aspect. It plays a pivotal role in managing emotional responses. A well-defined risk-reward ratio provides a structured framework that helps traders stay disciplined and avoid impulsive decision-making. Building trader confidence. Knowing that each trade is guided by a clear risk-reward ratio fosters confidence in a trader's decision-making process. Confidence is a powerful ally, especially in the face of market volatility and uncertainty. Section 4. Practical application of risk-reward ratios. Setting realistic expectations. Risk-reward ratios assist traders in setting realistic expectations. By quantifying the potential outcomes of a trade, traders can develop a more pragmatic perspective on what constitutes a successful trade and align their goals accordingly. Portfolio-level risk management. Risk-reward ratios extend beyond individual trades to impact overall portfolio risk management. A systematic approach to risk-reward ratios ensures that the aggregate risk across a portfolio is well calibrated and aligned with broader financial objectives. Section 5. Adapting risk-reward ratios to market conditions. Market volatility and risk tolerance. The dynamic nature of financial markets demands an adaptive approach to risk-reward ratios. During periods of heightened volatility, traders may adjust their risk-reward parameters to account for increased market uncertainty and potential for larger price swings. Incorporating market analysis. Risk-reward ratios are not static. They should be dynamically adjusted based on ongoing market analysis. Incorporating technical and fundamental analysis helps traders refine their risk-reward parameters to reflect current market conditions. Section 6. The pitfalls of over-optimizing risk-reward ratios. Avoiding over-optimization. While optimizing risk-reward ratios is essential, there is a risk of over-optimization. Traders must strike a balance between fine-tuning their ratios and avoiding excessive adjustments that may compromise the integrity of their overall trading strategy. The paradox of high reward and low risk. Traders may be tempted to seek excessively high reward-to-risk ratios. However, there exists a paradox. Striving for an extraordinarily high reward often requires accepting a proportionately higher level of risk. Understanding this balance is crucial for maintaining a realistic and sustainable approach. Section 7. Evaluating risk-reward ratios in different asset classes. Equities versus Forex versus commodities. Different asset classes may necessitate nuanced approaches to risk-reward ratios. Equities, Forex, and commodities each have unique characteristics that influence how traders evaluate and apply risk-reward ratios within these markets. Cryptocurrencies and risk-reward dynamics. In the dynamic world of cryptocurrencies, risk-reward dynamics can be amplified due to heightened volatility. Traders engaging in crypto markets must carefully assess risk-reward ratios to navigate the unique challenges presented by digital assets. Section 8. Advanced risk-reward strategies. Pyramiding and scaling in/out. Explore advanced risk-reward strategies, such as pyramiding and scaling in/out of positions. These techniques allow traders to adjust their risk-reward ratios as a trade progresses, optimizing profitability and minimizing potential losses. Option trading and risk-reward enhancement. Delve into how option strategies can be utilized to enhance risk-reward profiles. Options offer unique opportunities to fine-tune risk exposure and potentially improve the overall risk-reward ratio of a trading strategy. Section 9. Integrating risk-reward ratios into trading plans. Building a trading plan around ratios. Successful traders integrate risk-reward ratios seamlessly into their overall trading plans. A comprehensive trading plan incorporates risk-reward considerations from the initial strategy development phase to ongoing portfolio management. Periodic review and adjustment. Regularly review and adjust risk-reward ratios as part of a continuous improvement process. Markets evolve, and a trading plan should be flexible enough to adapt to changing conditions while maintaining a consistent risk management framework. In the tapestry of trading strategies and risk management techniques, risk-reward ratios stand out as a fundamental thread that weaves together prudence, discipline, and strategic decision-making. Beyond their numerical representation, risk-reward ratios are a compass guiding traders through the intricate terrain of financial markets. Through a comprehensive understanding of their significance, traders can navigate uncertainty with clarity, balancing the pursuit of profits with the imperative of risk mitigation. The journey of mastering risk-reward ratios is an ongoing exploration, where each trade becomes a lesson, and each adjustment refines the art of strategic decision-making in the dynamic and ever-evolving landscape of financial trading. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.